Ladies and gentlemen, good morning and welcome to Andy's market comment for Friday, the 11th of December 2020. So the big news to come out this morning was vaccine developer CSL will be making an announcement to the market because their COVID vaccine they're working with the University of Queensland will be cancelled because it's been providing false positives of HIV. So it just goes to show that the vaccine business is pretty challenging, and I suppose it's a good thing that they're actually going to can it. Pity about all the work that has been put into it, but at the end of the day, the public needs to be completely reassured that these COVID vaccines that are coming from a whole bunch of different pharmaceutical companies will work and will be safe. Because they're rapidly being developed, whereas current vaccines like for measles and polio, those sort of things have been out for decades, so we've got excellent data on that sort of stuff. So CSL will make a note about that today to the market, and I gather it'll have a little impact on their share price, but overall not too much. The other big news was the Aussie dollar. It's now at 75.37 US cents, so it's moving. It's really, really moving. Now, yesterday in my email to everybody, I made a note about three particular companies. I'll start with one of the fintech darlings, not Afterpay. Everyone likes it to be about Afterpay, it's not them, but the machine learning and artificial intelligence firm APX or Appen. They issued a trading update which amounted to a small profit downgrade. I mean, and actually it was an EBITDA downgrade, but let's not get too technical about it. But this is basically what they had to say. They're now expecting their FY financial year ending 20 underlying EBIT, including the impact of the higher Australian dollar, will now be in the range of $106 to $108 million. Okay, fair enough. They've now, comparing that to their guidance of a few months back, of it coming in at 108 to 111 million. So we're sort of talking about a $2 million spread here. But I think the market is more concerned that they're basing that those guidance figures on a Aussie dollar rate of 70 cents, and now it's at 75.5 just about. So that's going to have a little bit of an impact. Look, in my opinion, it's small beer. But the market at the moment is priced for perfection. And the stock got hammered yesterday. It closed, I think it was at 26.20. And it did hit an intraday low yesterday about 26.05. Bit early to see what it'll do now. Now, this is a stock that around about August 20, I think it was, it actually hit $43.50. Anyway, they do some pretty clever stuff. I think it's one to put on one's watch list to definitely have a good look at. And if it starts to, fall further, possibly get to 24, 23-ish, then that's probably going to be worth looking like, taking a position in. So that's just one there. Again, I put an email out to all the clients about that yesterday, so you can refer to that for more information. Back to uranium stocks. I'll just make this very quick one. The one I would look to play is Paladin. It's around about 20 or 20.5 cents. The lack of investment in the uranium sector over the last 10 years could, I stress the word could, see a price inflection, next year. So treat Paladin as like a high risk call option type investment, particularly in a real, beaten down sector. And I use that analogy because it's pretty cheap, like buying a call option. 20 cents is like buying call options sometimes on certain shares. Keep in mind, I think it was in August 2007, they once traded for $8.40, but they've been in the dumps, so it's very much a speculative trade to look at there. And lastly, I also put a note out about, which is, the best of the four banks, and I have my little table there where I compare ANZ, Westpac and NAB to Commonwealth Bank, and we come up with the ratio. And right at the moment, Westpac's got a ratio of about 4.18. That means for every CBA share, you can actually buy 4.18 Westpac shares. And usually when that's above 4, that represents a good value buy for something like Westpac. Incidentally, it's on a dividend yield of about 1.54%. That's just going on the last paid dividend. That's why they look relatively low. So it's just a value comparison with CBA. So it doesn't reflect any measure of actual value in Westpac itself, but it just basically says to me, if you're interested in getting into the banks, Westpac, in my opinion, is the better buy on the basis that you get more bang for your buck. As simple as that. And again, that was sent out in the email yesterday to everyone. I also put a chart in there that compared the 4 banks, and you can see how Commonwealth Bank again has just been like a bit of a runaway train. Again, price for perfection. But Westpac's sort of just been the bit of the laggard, so I think that's not a bad one to get. It's the old saying, buy the worst house but on the best street, and I think Westpac sort of fits into that there. Now, this is a much longer video today. I'm nearly clocking up to 6 minutes, so hopefully you've been able to listen in and bear everything here. The only other thing last night was Airbnb IPO'd, and again, market price for perfection. The IPO went nuts. And again, it's another business that doesn't even make a profit, but hey, it's Airbnb, everyone knows it and wants a slice of it. So there's still this exuberance within our market. Anyway, I hope you've enjoyed the video for today. Just on that note, anything I do say in here is general advice. I do put a general advice warning in the descriptor of the YouTube videos in case someone in ASICs, in ASIC land comes and picks it up. So obviously, I don't take into account, anyone who watches this, their unique financial situations. It's just my opinion on what I see things. So just always be mindful. And I think we'll wrap it up here. So have a great weekend, and we'll talk Monday. Take it easy.